Super League Limited, the assignments. Then I'll start explaining associates to you. We are going to sleep this night. Obviously, we don't know when we are going to sleep, but we are going to sleep. Let's read. What is the requirement of the question? The requirement says, prepare a consolidated statement of financial position of Super League PSC. Assets. Yes. As at 31st March 2020, in accordance with applicable international financial reporting standard. Good. That is the requirement of the question. Don't forget, Super League is the parent. Then how do we consolidate? Immediately you see in exam, they ask you to consolidate. One thing will come to your mind. You will open everything. Open it and open it wide. How wide you are going to open it depends on you. So I'll go to the question and say, no. I'll say Super League. Consolidated statements of financial position as at 31st March 2023. No current assets. We have PPE 19 plus 730. Investment in Dream League. Of 144. Financial assets. $45 plus 65. Investment property. $51. I will put the goodwill. Immediately after the goodwill, I'll leave two line space. Go to the current assets. Inventories. Inventory of the parent 45 plus 60. Trade receivable. $218 plus 203. Then cash. $157 plus 140. Total assets. Equity and liabilities. Share capital. After the share capital, retain earning. In the exam, I will leave a line space, NCI. Then I go to the non-current liability, the liabilities now. Non-current liabilities, 278 plus 180. Current liability, we have trade payable, upon trade payable, $120 plus $115. Other payables, $150 plus $170. Transaction, that's all. To balance this in exam, what is my own duty? I was open the group structure, all those things that I need. I need the group structure. How did they stand? Adjusted retained earnings of subsidiary as per statement of financial position. Then we need to determine the net assets. Open account for the net assets. Determination of net assets of subsidiaries. Then I need to calculate the goodwill. I will write the formula. Cost of investment. Add NCI, purchase consideration, net assets at the date of acquisition, goodwill. Then I will leave two lines, please. In case of impairment, this is it. Then I need to return of the parents to end. As per SOFP, then NCI. Date of acquisition. That's all. After I've done this, I will now start reading the question and be posted. After this is done, why do I always advise my students to open everything? You know what happened? The network just logged me out. Sorry. After this is done, I will just posting it. As I read, I become post now do. Super League. On 1st April 2020, the Super League acquired 80%. Opposed, they've given me the group structure. Parent is 80%. NCI will be 20%. Good. Of equity shares in Dream League for a cash consideration of 144. Has it been recorded? The payment. Don't forget what is the date of acquisition. 1st April 2020. And we have to consolidate 31st March 2023. We have to consolidate 31st March 2023. That's what he said. So, date of acquisition, workings now. Date of acquisition, which is 1st April 2020. When are we consolidating? He said we should consolidate 31st of March 2023. How many years is this? How many years is that?
3 years.
3 years. Thank you. 3 years account. He paid 144. I will ask the question. Anytime there's a cost of investment, has it been recorded? Cash payment, 144. How do I know it is recorded in exam? When I say it is recorded, cost of investment. How do I know? That means they post the cost of investment. 1, when the question is silent, it is recorded. 2, clearly stated it is recorded, or part of the cost of investment is recorded. Then 3, I will investigate through investigation. I will know with these 3 what to do. So what is the accounting entry when it is recorded? Remain investment, because it is there. I will credit minus cost of investment debit. Any type of investment, cost of investment, when it is recorded, this is your own entry. Anytime you say it is recorded, this is your entry. Anytime the question just says he has recorded any type of cost of investment, this is your entry. However, if it says it has not been recorded, I will now know the cost of investment that associate with each, the accounting entry that associate with each cost of investment. Good. Now, the 144 has it been recorded? Yes. When I go to the second financial to investigate, it is there. I will just say, okay, the 144 is recorded. Cost of investment, debit. For my good calculation, then I will credit investment. It's okay. 144 plus, because that is not the only cost of investment. I will go and credit investment in Dream League. Because if I don't do that, credit. That's all. Then, and through a share exchange of 1 shares for every 2 shares held in Dream League. Oh, apart from the cash payments, you also make a share consideration. Don't forget, what do we need to know in share consideration? It must be issued at the market price per shares of the parent. That is one. So if the parent is one issuing it, is the one that has the premium. The premium does not go to the net asset of subsidiary. That is one. Number two is that in case that the market price per share of the parent cannot be determined, that of the subsidiary should be used. The third one is that accounting entry. When there's a share consideration, cost of investment will be debited, equity share will be credited, share premium will be credited, provided it has not been recorded. The last one, which is the fourth one. In case there is no share premium in the statement of financial position for the parent, because it's the owner of the premium, it's the owner issue at the market price, share premium account must be created. That is it. So, this question I said, in a share exchange of 1/2, 1/2. But I'll first of all convert, say what is the total numbers of shares in subsidiary, because the values of shares all over nominal value. Go to the question. What is the values of shares? The values of shares of subsidiary is 270.
270.
Divided by the nominal value, which is always in unit, 50 kobo, 25 kobo, 1 naira. You will trace it, 1.25, 2 naira, 10 naira. You will trace it to the share capital. I hope you have bought shares. Majority of the bank wants to capitalize. So they are seriously looking for money. Send it back. It's seriously looking for money. And it's doing is it right issue? Is doing your public offer. FCMB, 7 naira 30 kobo per shares as at today market value. You can buy as low as 1,000 units. The only problem I have with investment in shares is not immediate investment. You might not even recoup your money based on Nigeria perspective. And those people, the directors, board of directors of the banks, they enjoy more than the shareholder. That is the reality of our country. Even with the intervention of corporate governance, we still don't get it right. We pray God we touch their mind and do the needful. So I cannot acquire shares acquired by the parents. .8 times 270. 0.8 times 270. Somebody should help me. Let's do it together.
So 16.
16. Thank you, my sister. The share consideration. How does he pay for the 216? You also pay cash and shares. For the share consideration, what is the exchange ratio? Which must be parent over subsidiary. One share for every two. 1/2 times 216. One over 2 times 216.
108.
108. So I will ask, what is the market price per shares of the parents? So let's read. When the return is 110, the market price per share of Super League PSC share at this auction was 2 naira. So cost of investment. They've given me the market price per share to be 2 naira. So cost of investment to be debited 108 times 2 naira. Then equity shares to be credited 108 times the nominal value of 1. Then, as it create a premium? Yes. Share premium now, which must be credited 2 naira minus 1 naira times 108. So, what is the cost of investment now?
216.
216.
So, the total cost of investment, the cash, and the share consideration. Has it been recorded? I will ask. I know that it has not been recorded because I have seen that it's only 144 that you pay for the cash that was here. So, share capital. What is the share capital of the parents? 300 plus 108. There was no share premium or create the share premium account. Share premium account to be 108. That's all. Then I'll go to the goodwill. Two 116. 144 plus 216.
360.
360. That's it. He has given me return at the date of acquisition to be 110, based on what we have read now. So I'll go to the question and say items, DOA, DOC, and post. Share capital. What is the share capital of the parents of the subsidiary? 270. Retain earning, which she has given as a date of acquisition to be 110. That's that. Any question? So far, so good. Any question for me? I hope I'm not too fast. Any question for me? I hope I'm not too fast. Because I have so many. 1, 2, 3. So additional information one. At the date of acquisition, the fair value of Dream League PSA assets were equal to the current amount with the following exception. A non-depreciable piece of land that had a carry amount of 250 had a fair value of 260, non-depreciable land. There is a revaluation surplus on land. What is the carrying amount of the land? You've given me carrying amount and the fair value. Look at it. What is the carry amount of the land? 250. Surplus of 10. So what do I do in exam? Say PPE, I will debit 10. Then the reserves, credit. That's all. It's a land, no depreciation. Valuation surplus on land of 10. That is that. Any issue? Any issue? Any issue? The absence of no issue. Plant and machinery with a carry amount of 150 had a fair value of 155. The valuation surplus of 5 million. What do I do? Go to the net assets. That is that. It must create a depreciation problem because we are charging depreciation. This. So for my depreciation, surplus five divided by what is the useful life of the asset at the date of acquisition? Well, yes, DOA to DOC, 3 years. That's all.
3.75.
Depreciation 3.75. PPE credit minus adjusted retail earning. Okay. Mostly for the weekend. So PPE, our credit 3.75. Adjusted retaining as it. Next. Internally generated brand name. The director specifically explained that the fair value of this brand, the fair value of the brand will be 20 million with a useful life of 4 years. Intangible assets, brand name, 4 ways it can be tested. 3 ways can be tested. When it is recognized as an asset by the parent, but it happens at the date of acquisition, then no issue. Last question. So for the brand name, second way, when it is written off, shortly after acquisition, they will tell you whether it's lower or higher, but written off shortly after acquisition. The third one, it was not recognized in line with IAS 38. Those are the 3 ways intangible assets can be tested. And those 3 ways have been tested as far as ICANN exam is concerned. So, but this one, it is recognized by the parents. They will give you the value of the brand name as a date of acquisition. And they also give us useful life so that we can charge amortization against the brand name. So what is now written? Don't forget anything that happens at date of acquisition must go to the goodwill calculation. So I open a brand name account, I say brand name, debit with the value, then I'll credit my reserve with the value of the brand name. Then the amortization, I'll get the amortization, credit the brand name, and debit adjusted retaining or subsidiary because there's
The
no
screen is no longer showing. Your screen. Sorry,
I'm not.
I think
just saying,
not your screen. You're posting, except you're just
I
explaining.
have not posted. I was just saying what can be posted as regarding tangible. Sir, intangible can be tested in 3 ways. As at this level, one of them is that the intangible is recognized by its parents as a date of acquisition. You will treat it as if you are treating surplus, valuation surplus on PPE. For the first one, I'll go to the net asset, brand name. I'll open it. What is the value of the brand name?
20.
20. Thank you. I will not add it to the goodwill. Goodwill is identifiable separately in line with IAS 38. It's a special aspect of the intangible. Goodwill is different from other intangible. So, brand name.
Okay.
This is what I said for the first one. The second one, which we are going to see next week in one of the question investment in associates, they will tell you that the brand name, they do the fair value. And after acquisition, it was written off. The third one, it is not going to be recognized by the parents in line with IAS 38. Those are the three ways brand name can come out. And you will know the three ways. Immediately we do question 1 or 2 or 3 questions on associates next week. The following week like this, will show you in cases SBR formats of ACCA, which is even easier than this. You are not up to consolidate, open everything. You will be correcting the error and redraft it. You just debit and credit. But if you don't know what to open, you will not be able to redraft. You start showing now how to go about it. So I need the amortize. What is the useful life of the asset? Amortization. What is the useful life of the assets of the brand name?
Oh, yes.
So I would say 20 divided by 4 times from the date of acquisition to the date we are consolidate, which is 3 years. So
15.
what do I do to the 15? My brand name account will be what? I'll say brand name account.
Credited.
Or credit minus 15. Then the adjusted. With any of the owner subsidiary, I will debit. That's all. I'll just go to the account. No thinking is required. Just go to brand name, minus 15, we have used this. Then I go to the adjusted retain, it's okay, amortization on brand name. I'll debit. As per statement of financial position, what was in the retained earning of the parents? As per statement of
330.
of subsidiary income.
No, sorry, of sub is 330.
Top
This is
330.
330.
Yeah, sub is 330.
Then for the parent,
600.
600.
600. 600. This is what you have done in your FR 600. If you have done your FR very well. That's all. That's the non-controlling interest on at first April is April 2020 was 108. So they've given me the value of non-controlling interest to be 108. Is an indicator that NCI is valued at fair value. Does it give me group policy? Because it has given me the value of NCI at the date of acquisition, which must be at fair value. So I'll go to the question. Is there any group policy? No group policy. Therefore, NCI is valued at fair value unless it otherwise stated. So for my goodwill calculation, I'll put my NCI 108. Then go to the goodwill. Add NCI 108. So 108 plus this will give me 0. 14 for 540. That's it.
So you're writing 180 is 108.
468.
It's 108. Sorry, my sister. Thank you. The other one, what do we put there?
For the NCI, 108, it was correct. I think.
No, for the NCI, I wrote 180 again instead of 108.
Oh,
108. Therefore, the purchase consideration will not give us what?
468.
$468. That is it. On Sunday, it's likely we are going to run this class 2 to 5 to start investment in associates. So by next week, we'll have done so much on associates. Then the following one, we can do fellow subsidiary, because I've Saudis now will be inculcated. I've put the proposal, they refuse to pay for the service fees. Don't worry. There's a way God rewards somebody. So that is that. Let's go and check the second leg so that we know we are safe. Is it 180 or 108? All right. Just want to see me see trouble. Can somebody make this kind of mistake in exam?
The whole answer will collapse.
Straight. 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 Osanio. That's why you must pray for the village people not to attack you on the exam day. So many things happen under 3 hours. So many things up under 3 hours. Okay, that is done. Only the cash consideration has been recorded by Super League. You don't need to tell us. We have investigated. You have seen. Greenleaf PLC has not issued any additional shares since being acquired by Super League PLC. A further fair value adjustment referred to in one above have not been incorporated in the above statement of financial position. Yes, we know. We are still going to do the one that we incorporate to show you what you are to do. The financial asset equity instrument is Super League and Green League are classified as financial asset through profit or loss in accordance with IFRS 9 financial instrument. Don't forget IFRS 9 financial asset can be fair value in 2 ways. It's either fair value through profit or loss or fair value through other comprehensive income. If it is other comprehensive income, any changes will go to the OCI. Don't forget to remember that when we are talking about POA, we are referring to retained earning. When we are talking about in the statement of financial position, anytime you hear P or N issue, it's the same thing as well, retained earning. And when we talk about OCI, we are also talking about other equity components. That is what we are saying. So other comprehensive income, if the fair value, we put it in OCI, they did not give me profit or loss. I will just wait another component of equity. Okay. Then let's do at the fair value. Don't forget, it does not happen at the date of acquisition. It's in the book already. It's a different ballgame if they do the fair value on the date of acquisition. The values in above in the financial statement are fair value since they purchased during the current accounting year. Okay. The fair value of the financial asset equity instrument is Super League and Dream League PS as reported as 31st March are now 30,070. Oh, I'll go and check what is the carrying amount of the, it's okay, for the parents and the subsidiaries. What is their carrying amount of the financial assets? And what is the fair value? I'll go to the question. What is the carrying amount? Go to the question. The carrying amount in the book for Super League, we have 45. And for Dream League, which is subsidiary, we have 65.
65.
Now, is there fair value gain or loss? I don't know. For the parents, what is now the fair value?
30.
30 and 70. Parents is 30. While subsidiary is 70. So this will lead to fair value gain or loss. For the parent, the carry amount, he had the loss of 15. So what will I do for the parent? I'll credit the financial assets credit minus 15. Then I will debit his retained earning of the parent. Retained earning of parents will debit it. That's all for the parent. Then this is a fair value gain of 5. For the sub, he has again the financial assets will be debited plus 5. Then I'll go to his retained earning of subsidiary and credit plus 5. That's all. No issue. I'll just go. The first one for the parent. We'll go to the parent account. Fair value loss on financial assets. That's all. Then to the subsidiary. I'll go to account of sub. Fair value gain. That's all. Next. Super League policy of carrying his fair investment property
Depreciation is
at fair value.
3.75.
The fair value as attachment management. Huh?
I said the depreciation is 3.75, not 375.
It's 3.75.
It's 3.75. Okay.
Thank you. So, fair value of investment property is 55,500. So what is the carry amount of the investment property? I'll go and check in the book. 51,000. So there is a gain on investment property. Who is the owner of the investment property? The parent, not for the subsidiary. So fair value gain. Which is 5.5 minus 51. What does it give us?
$4.5.
Thank you, my sister. That is it. General information 6. In the post-acquisition period, which Super League PLC obtained control of Dream League. Super League sold goods to Dream League PLC for 35,000 at a margin of 25%. This is not markup, it's a margin. 15% worth of the goods we are seeing inventory of the Dream League. So let's do that. What is the total sales? Sorry. Mr. Robert, what do you normally take so that you will not sleep?
No, just to listen to you.
That will make you sleep well now. Even me that is writing. I think feelings, we must have gone to work for the day, coming back. Elvis, how do you do it? That's my sister. I used to say active and give me figure. How have you been doing it? Or is the pressure of the exam is not making you to sleep?
Yeah. Yesterday I slept off during SFM.
It's normal now. If you have worked through the day, I will not sleep, but you have the opportunity of going to the video to go and rewatch it. But the problem is, which time will you still have to listen to 3 hours lecture again? That is the problem again. It means you must doing it bumper to bumper. Listen, doing the exam, doing the lecture, make sure you do your own thing. Don't let it pile up by weekend. Let's assume that you want to write 5 papers. Saturday, Sunday, there will still be lecture on Saturday. On Sunday, how do we listen to all the 5 papers? And you will still need to go to church to go and pray. Why is this important? God will help us. It's not easy. Nigeria, hard life everywhere. Everything in Nigeria is hard life. So the total sales, according to the question, is 35. Immediately I start saying this, I will remember this unrealized profit on inventory. You have given me the total sales to be 35. And you also tell me that it's a margin. Margin of how much? How many percent now?
5.
Margin of 15%.
Margin of 25%.
5%. But your sold now is 15%, which is 0.15 times 35. How much is your sold?
$5.25.
5.
0.25.
How do you get?
So Unrealized profit on investment 15 over 100 because it is margin times 5.2. And if you can get our seller account consolidated inventory.
No, 25.
25.
25 over 100.
Thank you.
Mm.
The margin is 25%. Unsold is 15. So 25 over 100 times 5.25.
1.313.
1.313. That's 1.31. What do? I will debit the seller. Who is the seller?
The
Parents.
parents.
I'll go to the parent account. Why do you sell and make profit from your subsidiary? It's not allowed. I'll go to the consolidated inventory and credit. So I hope on Sunday that 2 o'clock is okay by you. I hope on Sunday 2 o'clock is okay by you.
Yes, sir. Okay.
So, huh?
It's okay.
Mr. Kalim, it's okay if this Sunday will make us finish before maybe by the end of October. If this Sunday will help us to finish by say latest October, so that we can have the whole of November free.
Definitely, that's my
Do
target.
revision.
That's my target. So we introduce 2 to 5 on Sunday, 2 to 5. To 5. Introduce 2 to 5. So a minute.
Please, I have a question. Good evening. Can anyone hear me, please?
I can hear you.
Okay, so if I'm
Hello.
unable to make the 2 to 5 class, will the class be recorded so that
My
I
voice.
can always catch up?
Yes.
Okay, because when I checked the YouTube, the classes we had the last time, I can't find them there. It's just the first 2 classes I can see. The remaining classes I cannot find them for the group.
Are you sure of this?
I still checked today, except maybe yes, I still checked today.
All the past lecture is not there.
Sorry?
All the past lecture.
Okay, so I could see 15 lectures that were updated there, but I could only see the first 2 classes on group. The last one we had, which was last week Wednesday, I don't think it was uploaded.
I'm sure, but the boss only they will have uploaded it.
Okay. All right, no problem. Thank you very much.
So you'll not be meeting up on Sunday or just this Sunday?
I won't be meeting up on Sundays.
Why?
But you can you sorry?
Why? Why?
Because my own service is in the evening.
Oh, hey, you can decide to go
Well,
the morning one now.
okay, no problem. I'll look into that.
Please go to morning one. That's for the meantime.
All right. Thank you.
I understand the importance of church, but what can we do? Okay, let's see additional information next. Dream League PLC at 31st March. Okay, current account balance for this intergroup sales at 31st March 2023 was 7,000 in Super League and 3.5 in Dream League. The difference in the current account balance is due to a cash in transit from Dream League. Yes, dispatched on 26 March, but only received on 8th of April by Super League. So there is a cash in transit of 3,500, which was received after the year end. So I will post it because Dream League must have done the needful. I told you trade receivable, trade payable reconciliation can only be tested in 3 ways. One, when they agree to the owing. That is the first one. The second one is total cash in transit. And the third one is part in transit. Just like this question, there's a part in transit. So in example, what is found? You cannot owe each other. I'll just go to the trade receivable, remove the total owing minus 7,000, that would be 7. The account is in thousands. I mean, what is the account? Okay, minus 7 is in thousands. Then the one in transit, I will debit my cash. The one in transit of how much? 3.5. I will debit plus. Then I'll go to the trade payable minus. That's all. That's all. Then the last one, as at 2023, goodwill in Dream League PLC has been impaired by 15,000. So even though I've not gotten an answer of goodwill, I'll post. It has been impaired by 15,000. So I'll say impairment. Of 15. It is fair value. The impairment must be suffered between the parents. Between the parent and NCI. So let's go to the account of the parent and NCI to remove the PLC impairments. Out of the 0.2 times 15, then parent own 0.8 times 15. That's all. Zero 0.8 times 15 will give us what?
Mommy.
3.
Mommy.
Hmm?
Mommy.
Oh, yeah, give me figure. Let's do it together.
12.
12. So this one will be 3.
Excuse me. Excuse me, sir. Please, I want to ask a question.
Ask your question, my sister. Ask you.
Please, the return earning of the parent company at the inventory, the unrealized profit, we credited 1.3, and when going to consolidated account, we credited also that unreported profit, unrealized profit rather, from inventory. Are we not meant to debit it there, add it there and minus it here? Because you are minusing it twice. The two entries they were credited.
That your,
I don't understand it.
and you talk fast, please. Let me get the question so that I can respond.
I'm so sorry. I said the
Okay.
unrealized profit at
Mhm.
the parent inventory, at the parent
Good.
retained earning,
Mhm.
it was 1.3 credited. Fine.
No, not
Getting
credit,
to the
with
cost,
debit. With
is
debit.
it debited? But you bracket it now.
Yes. When we are debiting retaining, we are bracketing it. We are removing.
Okay.
Retaining just like your income account.
Yes.
So if I'm debiting income, I'm reducing it.
Okay, we're reducing it. Are we also reducing
And
it there
inventory,
at the inventory? Are we also reducing it at the consolidated
yes,
there at the
now,
inventory?
yes, to bring it to carrying amount, to bring it
To
to
bring
cost.
it. Okay.
And
Thank you.
inventory is an asset. If I'm crediting an asset, I'm reducing it. It must be eliminated. You can't make profit, you can't add it to the goods.
Okay, thank
I
you.
hope your question is answered.
Yeah, thank you, sir.
Welcome. Next. That is the end of the question. We now consolidate. Do you get it up to this level? Because I was impressed by your solution anyway. So with this now, I can think you get the majority of the answer. So thanks so much for your solution. It's a way of feedback to us. So what is the total assets now? 270 plus 110 plus 10 plus 5 plus 20.
No. 415.
415. So 415 will be subtracted for the purchase consideration. So 468 minus 415, that will give me the goodwill at the date of acquisition. 468 minus 415,
53.
53. So I will less the impairment. What is the goodwill at DOC? 53 minus 15.
38.
53 minus 15.
38.
Goodwill to be reported. Thirty-eight. Brand name is 5. Okay, let's go and share profits. Adjusted retained 330 minus 3.75 minus 50 plus 5.
Good impairment is missing.
Where?
Within earnings of sub.
Don't do that. Don't do that. Impairment will
Okay,
not
the
be
good
there.
impairment. Yeah.
It will be in NCI now. Impairment will be in NCI.
Yes.
Oh, yes, it's in NCI. Sorry. It's in NCI, not sub.
The total
Because
is
it is fair
316.
value. Both of them will share it. Our credit
Yes, it's
goodwill,
NCI.
debit
My
retained
error,
on
yeah.
parent, and debit reserve. Okay.
Yeah.
31
316 approximately.
point
0.25.
so 270, the shares does not change. Returning financial surplus on land 5. The figure you give us now, what is the figure? Okay, 316.25. DOC minus DOE.
The balance.
316.25 minus 1110.
201.25.
2.
201.25.
So that is the share of profits, the share post acquisition profits. We're going to collect share profits. (0.8 times 201.25).
Sorry, sir. Confirm, sir.
Is 206.25.
Are you sure?
Yes, sir. Yes, sir.
Well, why do you decide to give us wrong number? What do we do for you? 206.
Yes, sir. 206.25.
Zero 06. 0.25. Share profit now. This will give me share profits. 0.2 times 206.2. So what does it give us?
It's 41.25.
But 1.25.
One 46.25.
1.
146.
146. So what is the total return?
Sorry, that is 165 or not
It's
165.
165.
165.
So I will sum them.
165 round, no 0.25.
What is the total?
Seven point 741.19.
Somebody should confirm if you go.
741.19.
Yeah.
Hello.
741.19.
Nice year.
That's
That's one
1.25.
146.25.
146. So please help me count the two number 741.19 and 146.25. Okay, let's start adding. So I'll give us 408.
Seven four 1.19.
Which one?
Retained earnings.
NCI.
Share premium 108.
NCI.
316.25.
Next, triple
NCL 458.
Which one is that?
Non-current
Non-current
liabilities.
liability.
Non-current.
458.
458. 4.
Triple
231.5. 320. 257.
57. So PP BP
is 1651.25.
165.
1651.25.
Then financial assets
100.
inventory, trade receivable, and cash.
Inventory 103.69.
103.
103.69.
Trade receivable,
414.13. 414.
414.
414.13.
Point what?
13.
That is for 0.13.
Yes.
That is it
Where
for
do you want
cash or trade receivable?
414.13 is trade receivable.
How do you get 0.13 here? This is minus 7.
Oh, okay.
218 plus 203 minus 7.
Yeah, I added
It's 414.
yeah. I was mixing up 414.
The cash,
302.5.
202. That is the total. Let me reduce it to 50.
Something wrong. 144.
We'll sum it up. What is the total assets? What is the total assets?
2669.94.
269.94.
2669, like 2669.94.
Let's go and check the equity and liability.
The same thing.
What do you say, my sister?
It's the same thing, no. 2669.94. It balanced.
We'll take your word by it. So the first one is what?
2669.94.
669 points. That is it. So 2669 points. That's all. Ish. So I'll send it to your platform. Yes, I sent one. Let me send another one. Open to PEP. Let's do PEP. Open to PEP. Are you there? PEP PSC. Let's see how far we can go on PEP. Yeah. Have you seen it? PEP PSC. Question 5, doing the acquisition. PEP PSC. So, question says, what is the requirement? Yeah. Consolidated statement of financial position as at started June 2015. PEP PSC. 2015. So I opened the account. Let's open non-current assets. Non-current assets. PPE. 55,000 plus 28,600. Financial assets. 11,500 plus 6,000. Then goodwill. After the goodwill, I leave two line space. Go to the current assets. Now the current assets, we have inventory. Hello. Iri?
Mommy, mommy, look at this dog. Mommy, this, dog, dog, dog.
Equities and liability. Share capital. Share capital. Other equity components. Any. Potential. Und. Current liability. Immediately this is done. Open. Group structure. Adjusted. Chain of subsidiary. SFP. Determination of net assets. Items. GOC. Goodwin. Goodwin. Cost of investments. Add NCI. Issues consideration. Net assets. Date of acquisition. Then we have our goodwill. I will leave 2 line space. Case of impairment. Then the tenure of the parents and NCI. Tenure of parents. As FP. NCI. Good. You now start reading on the post. On 1st of January 2015, date of acquisition. 1st of January 2015, date he acquired. Workers. Date of acquisition, 1st January 2015. Which date am I consolidating? Let's check.
30th June.
30th June 2015. Oh, 6 months account. No retain during the year acquisition. Nobody will give me retain any. Acquire 75% of one equity share by means of immediate shares in or 2 shares in PEP or 5 shares in more. He has given me the group structure, parents, 75%. NCI. As well. Say by means of share exchange, 2 for 5. But I need to know what is the total number of shares in subsidiary, because the values of shares all over nominal value. Value of shares is 20,000. Divided by the nominal value of 1 naira. Give me 20,000. How many shares does he acquire? 75%. So 0.75 times 20,000. What does it give us? Zero point 0.75 times 20,000. Very short.
$15,000.
2,000. That's good. So, share consideration, don't forget. Exchange ratio. Share consideration. You've given me the exchange ratio. So 2 for 5. Hello. 2 over 5. 2 over 5 times 15,000. 2 over 5 times 15,000. What does it give us?
$6,000 shares.
It must be issued at the
That-
market price per shares of the parents. We'll go and check.
Times 4 naira.
The fair value of PEP and more shares on 1st January are 4 naira and 3 naira. Okay, that is it. 4 naira and 3 naira. So I will ask the question, why do you give me that of the subsidiary? Is an indicator that SCI is valued at fair value.
Okay.
It's an indicator that SCI is valued at fair value. So what will I do? It's very simple. I'll go to the question. It's an indicator. I'll go and check what is the group policy. If you go to the last additional information, which is 6, PEP policy is to value non-controlling interest at fair value at the date of acquisition. For this purpose, no share price at the date is representative of the fair value of shares held by the non-controlling interest. I can post that. 3 naira
Yes,
per
because 3
shares.
naira.
So I can know the value of shares now. 3 naira. Out of the 20,000, parents acquire 5,000 shares are held by the NCI. So NCI, the date of acquisition, the 5,000 shares at a rate of 3 naira to give me 15,000. So for the goodwill calculation, will now be 3 naira plus 5,000. Give me 15,000. I'll quickly post that. Then I'll go to what I'm doing. Parent share is 4 naira. So the cost of investment will be debited 6,000 times 4 naira. So I'll give me 24,000. equity shares, we credit 6,000 times the nominal value of €1 to give me 6,000. I say create a premium, yes. Now give me 6,000 times 4 minus 1, which is €3. Cost of investment debit. That's it. That is it. Any issue? Any issue? So the answer of no issue. I will ask the question, has it been recorded? I will ask, has it been recorded? Let's go to the question and answer. What you say about it? Pep has not recorded any of the consideration for more in his financial statement. He has not recorded any of the consideration. That means it's more than one person coming. He has not recorded. I will record now. Cost of investment debit 24,000. For the goodwill calculation, cost of investment debit 24,000. Equity shares credit. Share capital of the parent. What is the share
20,000.
capital of the parent?
20,000.
20,000. There is no share premium, but we have other component of equity. So what is the other component of equity of the parent? 4,000 plus 18,000. That's all. That's all. A minute, let me take water. That's all. Any question? It does not stop there. He also acquire, we also use different consideration to acquire. Okay. That's not the only cost of investment you use. In addition to the share exchange, where we make a cash payment of 102 kobo as shares acquired, deferred on the 1st January 2016, future payment, deferred consideration. For deferred consideration, don't forget the formula. Present value equals to future value. This is deferred consideration. Money at 2 kobo times 15. At what rate? Cost of capital of 10%. On the date of acquisition, the date of payment. You acquire 1st of January 2015, 1 year. Don't forget, we have to consolidate for 6 months. I need interest of 6 months, not 1 year. What do I do now? 1 after 2 kobo times 15, what does it give us?
19,800.
I'll put it into the formula. What is the present value?
18,000.
18,000.
18,000. Next, I need to determine the finance cost. How do I determine that? Don't forget future value equals to present value plus interest. What is the future value? The present value of 18,000. So I collect the lifetime. How much is the interest now? That is 1/8. I only need interest of 6 months. 900. It has not been recorded. Cost of investment debits. Finance cost will be debited to parent account. Also, okay. Present value will be debited to cost of investment, which is 18,000. Then the retained earning of the parents will be debited of 900. The liability, current liability credit 18,900. That's all. It has not been recorded. I'll go to the question. It has not been recorded. Cost of investments. $18,000. That is it. Then the return of the parent will be debited for 900. Next course. Then the liability. That is all. That is all. Next. Additional information one. The business is 60 now. 60% of its annual profit is made in the period January to 30 June each year. We are still coming back to that. At the date of acquisition, the fair value of net asset equal to the current amount with the following exception. Item applied with a value of 2 million below the carrying amount at the date of acquisition. This is not surplus, this is deficit. Opposite of surplus. Share capital, 20,000. No other component retain earning. They will not give me. It is during the year acquisition. Revaluation, deficit on plants. That is it. Then I'll go to the PPE. You have a deficit. That's all. Any question? I'll take the depreciation. They give me the depreciation or useful life of the asset. 2 years. On date of acquisition, what does it give us? What does it give us?
500.
500.
Hmm?
500.
Well, go to the PPE. That's all. Next, the fair value of investment was 7 million. See note 5. Say exception at date of acquisition. What is the current amount of the investment is 6,000. The fair value is now 7,000. As at date of acquisition, fair value of investment, which is the financial asset, FA, say it is 7,000. But I will need to compare with the carrying amount in the book. So, fair value adjustments on financial assets. The carrying amount is 6,000. Because if you go to the financial statement, subsidiary has 6,000 and the fair value as a date of acquisition will be 7,000. So fair value gain or increase in investment $1,000. So I'll go to the investment. Plus 1,000. It happens at date of acquisition. Increase in investment. That is it. That is it. But let's say again, see note 5. Let's go to note 5. I've started doing the fair values of financial assets, equity investment in paper more. We are 13.2 and 7.9. So the financial asset has increased in value as a DOC. From acquisition, the subsidiary one has increased from 6,000 to 7,000. As at 30 June 2015, when we are consolidating as reporting date, fair value against the carrying amount for the parent or the sub. Subsidiary is now 7,9. Don't forget 7,9. But the carry amount now is 7,000. For the parents, 11,5. $30.2. Next, investment has increased further by 900 for sub. Yes. But for the parents, so what do I do? Investment will increase by 900. Okay. Investment plus 1 plus 900. Bring it to 79. Asset acquisition carry amount is 6,000. The fair value of 7,000. We adjust for it. Then as a DOC, the date of consolidation, it has become 79. What do I do? To bring about post-acquisition gain. DOC will now be 19. For the parent own, as again,
Where do you get 19 from? The 1,000 plus the 900
fair value
gain.
gain.
That is 900 plus 1,000. That is how we got the 19.
Yes. But for the parents, it has become from 11.5 to 13.2. 13.2 minus 11.5. Starting 2 minus 11.5.
That's a revaluation loss. Great.
No, it's again, no, 11.5 is the current amount in the book. And as at reporting date, the question says it has become 13.2.
I'm mixing it up. I want to put it the other way around. Yes, again.
Have you seen it?
That table you drew. I think this is where
Here's the table.
This is the fair value 11.5. The carry amount should be 11.5.
Thank you, my brother. You should know the reason why it is like that. It's not easy here for me to hide that. In the book, the carry amount because they've given us in the book. Yeah, this is the carrying amount. Why this is the fair value.
If the fair value,
This
then
one is wrong.
the sub should be 7,007.9.
So this is 17. 13.2 minus 11.5. Is that not 17?
That's 17, yes. That's again.
What do I do to the 17? 17 fair value gain of 17 is 17.
You credit within earnings of parents, have you?
Yes. Then we debit in financial assets to bring it back to 13.2. Okay. In an investment,
Why are we adding to PPE and financial assets at the same time?
And I've cancelled one. It's an error here.
Okay, okay.
So, parents, awesome. Next. This aspect I want to take is important. We'll quickly finish it on Sunday, then move to investment in associates. It's 11 already. Yeah, so feeling dizzy, not be small. So on Sunday by 2 o'clock, exactly 2 o'clock, I will send the link before then. Ask Mr. Wasim to send the link and